All right, welcome to a presentation on the new Tennessee Debt Manual for Local Governments. I'm Betsy Knotts, and I'm the Director of the Division of Local Government Finance here in the Comptroller's Office. Our agenda today is pretty straightforward. I'm going to explain why we have a debt manual, where you can find it, and provide a summary of sections 2 through 5 of the manual. Those sections go over kind of general information on debt issuance in Tennessee. I'll also provide a summary of sections 6 through 8, which go into more oversight agency responsibilities. And lastly, I'll provide a brief summary of section 9, which is best practices in the debt arena. I'd like to pause here to remind you that there is absolutely no expectation for you to memorize this information. The manual is meant to serve as an easy reference tool for you. And so when you leave this presentation, I want you to feel confident that you can find the answer in one of our manuals. And if not, then you'll give us a call. And I hope everyone's familiar with our map at this point. It's been around a little over a year now. We divided the state into 6 regions. Each region has a designated financial analyst, and on the map is their direct contact information, their phone number and email address. We also included the general email address, which is good to just memorize. LGF stands for Local Government Finance at cot.tn.gov. That's where all your requests for approval, for budgets, debt, anything you need, you send it to that email address. All right, so why do we have the debt manual? And the simple answer is because state law requires it. State law gives our office the authority to draft guidance and prescribe forms. And this type of guidance goes before the State Funding Board for approval. So it's also subject to a public comment period. The State Funding Board, in case you didn't know, is made up of the governor, the comptroller, the treasurer, secretary of state, and the commissioner of finance and administration. The real question in my mind, though, is why does state law require us to do this? To answer this, we have to ask ourselves what kind of money we are using to pay back these loans that we take out to finance projects in our communities. And that money, as we all know, is taxpayer and ratepayer money. So state legislators have made policy decisions on behalf of their constituents to make sure that governments are accountable for this kind of money. And it's done by providing a consistent and limited framework within which governments are allowed to operate. The debt manual is meant to be a one-stop shop for your questions related to our oversight and our role within that limited framework. So where can you find our manual? It's like everything else these days, it's out on the web. If you don't already have our website bookmarked, please do. It's comptroller.tn.gov. It's a robust resource for local governments. You can see in the drop-down here, you've got information on audits, investigations, property assessments, so anything related to property tax, all of our finance functions, as well as open records and open meetings resources. So I highly recommend you bookmark comptroller.tn.gov. Now, if you're going out to look for the debt manual, you're going to scroll down to local government finance. And once you get to our site, you'll notice there's 4 buckets of information. The debt manual, of course, is under the debt portion. It's that first link there that says debt guidance. And you just go to it. You can print it out. You can save it to your desktop. I printed out a version and brought it here today. It's not that thick. The nice thing about saving it to your desktop in a PDF form, you can use the old Control F. If you're wondering, how do I get a capital outlay note approved? You can just go out to your PDF version of the manual, hit Control F and type capital outlay note, and it'll take you right to it. So there's a lot of different ways to do it, but I encourage you to go out to the website, check it out, give us feedback. Another thing that's shown on the slide that I wanted to highlight are these local government finance instructional videos. So hopefully if you're watching this one, you found it via our website. And I wanted to say, we put some tools out there. When the pandemic first hit and basically the economy shut down, we just got tons of phone calls about questions. How do I estimate revenues in this climate? And we just really didn't have resources at that time. And so we came up with a tool. We came up with a video. And so good things come from you giving us feedback and asking us questions. So I encourage you to go out there and contact us. All right, so the debt manual overview. It was approved on June 15th, 2021 by the State Funding Board. It is the first edition. There are two main uses for it. First, it's the introduction to debt issuance in Tennessee, and second is the step-by-step instructions on how to request approval or other review services from our office. So if you need a refresher on how debt issuance works in Tennessee, I recommend you read and consult sections 2 through 5, as well as 8 and 9. If you need to know when to submit something to our office for approval and how exactly to do that, then go to sections 6 and 7. All right, so this slide basically puts everything that's in sections 2 through 5 on one slide, which I kind of did on purpose. It shows you the most common types of issuers. There's just some examples. The most common types of debt that you'll find in Tennessee, the revenue streams that pay back those types of debt, as well as the processes that you can follow to sell those types of debt instruments. And I put it all on one slide to make the point that this is it. This is that limited framework that I was referencing at the beginning. It doesn't have to be that complicated. So if you can't point to something on this slide when you're getting ready to borrow money for a project, then you might want to question it or give us a call and we can help you out. Just to emphasize, there is no such thing as off-balance sheet debt in Tennessee. So in a nutshell, if a government wants to borrow money, it needs to be an authorized issuer, which is described in great detail in the manual. You need to have that proper debt instrument, bond, note, lease financing, loan agreement. You've got to have something to pay it back with, and you've got to have a purchaser. If it's portrayed to be a services agreement, but it involves paying someone to purchase something, or if it's a really long payment arrangement, you really should question that and call our office for advice. All right, so let's unpack this a little bit more and look at this handy chart that's included in the manual. There's 5 columns along the top. This, of course, is a chart of different issuers in the state of Tennessee. So you've got your types of issuers over here, the authority that created that issuer, the authority for them to borrow money, whether they have the ability to levy a property tax, and then the different kinds of debt that they can issue. What's interesting on this slide is you'll notice the cities, counties, and metro governments, their creation authority is very different from their debt issuance authority. And so their debt issuance authority is a little more complicated for those types of entities. But you'll notice that the remainder of the slide, the creation authority is the same as a statutory authority to issue debt. So that's usually going to have a section where it says this entity has the power to borrow money, like pretty straightforward, nothing too complicated. You'll also notice when you get into that realm, it's all revenue at that point. They're not involving property taxes. A couple things to highlight, though. You'll notice here for housing authorities, it says TIF. So taxing authority, no, but TIF. And that stands for tax increment financing. So housing authorities and industrial and development boards can issue loans secured by tax increment revenues, which are property taxes of the local government. So these kinds of loans are secured by they aren't secured by the local government's property tax pledge or the general obligation pledge directly, but the loan certainly is being paid back by property tax revenues. The whole idea in tax increment financing, which again is housing authorities and industrial development boards, is but for that tax incentive, the area would not otherwise be developed or improved. And so the revenue stream is tied to the enhanced value, and it can be given up by the local government and used to pay back the loan. That's the whole policy behind tax increment financing. You wouldn't have that improved area if they hadn't moved in and developed it. And so they receive that portion of the enhanced value in revenue to pay back that loan. Sometimes these loans can go out beyond the statutory limitation. So the statute says 20 years for industrial development boards, 30 for housing authorities. Or in some cases, maybe it's not solely owned by the governmental entity. There's a portion owned by a private entity. That needs to come to our office as well as Department of Economic and Community Development for a best interest determination. The attorneys at the State Board of Equalization handle those reviews, but certainly if you have any questions on tax increment financings, you can reach out to me and I'm happy to help. All right, so the rest of that lovely chart that's in the manual, this section goes over local government authorities as well as special assessment districts. So special assessment districts are interesting. So they're down here at the bottom with the asterisk. They're not legal entities which are authorized to directly issue debt, but they are areas in which a special assessment or an incremental tax revenue stream is designated to be available for payment of debt service. In most cases, such debt would be issued by another local government entity, such as a city, a county, a public building authority, or an industrial development board. An example of this is the CBID, the Central Business Improvement District here in Nashville in the Gulch. If you go out to dinner in the Gulch and you look at your receipt, you'll notice there's an extra line item for an assessment. And that is the special assessment charge that you're paying. And it's being used to provide public services in that area or perhaps even make debt payments for capital improvements that have been made in that area. But again, on this slide, most of these are purely revenue. You'll see lots of no's in the ad valorem tax column. So we have a lot of entities in Tennessee that survive on fees and charges. All right, so I wanted to highlight one of the handy illustrations in our manual. There's quite a few of these in there. This one in particular shows you the flow of funds in a typical bond transaction. So just by way of background, bonds are typically long-term debt instruments, and we make that distinction in the manual, as opposed to a note or a financing lease. Those are going to be shorter term. And like other debt obligations, a bond is the issuer's promise to repay a set amount of money plus interest on a specific date. And you'll notice here, it all starts with the local government. So the local government has a need of some sort to purchase or construct an asset. And so they most likely will hire a municipal advisor and some other professionals to help them with the transaction and the sale. And they'll sell bonds and go over here to the investors who purchase it and send the proceeds back over to the local government in order to make that transaction, in order to purchase that asset. And then it's time to pay it back. So whether it's secured by property taxes or fees and charges, those payments are made back to the investors. And you'll notice here, we made a note that not all bond transactions in Tennessee involve these two middlemen, the trustee and the underwriter. So they can be a lot more direct. The illustration also kind of summarizes in plain English how those professionals tend to charge for their services. So underwriters are generally compensated by a discount to the purchase price of the bonds. An example would be $5 per bond. Trustees tend to earn an annual fee for making debt payments to registered bond owners. And municipal advisors are hired by local governments to assist in the bond issuance process and are compensated per transaction. So municipal advisors do have a duty of care and loyalty to the local government that hires them. So this is the last slide in the general information portion of the presentation. So let's go ahead and close the loop by going over some distinctions between the most common types of security for these debt instruments and the ways to sell them here in Tennessee. As we saw in an earlier slide, counties, metropolitan governments, and cities are generally the only local government entities that have the legal authority to impose property taxes. These are the entities that issue general obligation debt. So general obligation debt is often described in Tennessee as being backed by the, quote, full faith and credit of the county, the metro government, or the city that's issuing it. General obligation or full faith and credit is essentially a fancy way of saying unlimited property tax. It's an unlimited property tax pledge. It's a very, very strong form of security. In fact, if the local government fails to levy the tax at a rate sufficient to pay the debt, the holders of the debt, so these are the investors on that prior flow of funds screen, they can force the local government through a court proceeding to raise taxes in an amount sufficient to pay that debt service. So it's a very strong and well-respected security for debt in Tennessee, and we want to keep it that way. But there's also something called limited tax debt. And so this is kind of what I was discussing earlier with the Central Business Improvement District in the Gulch area of Nashville. It's known as special assessment debt. This kind of debt is really common in a lot of states, but not very common in Tennessee. A special assessment, which is essentially a type of limited property tax, can be imposed on a specific district or area. And these assessments are typically collected by the city or the county in which the special assessment district is located. The special assessments are sometimes used to pay for public services in that area. They can also be used to pay down debt used for capital improvements in that area. Because the amount of the special assessment is typically specified and limited, it's not typically considered a general obligation debt. It's more accurately characterized as a limited tax debt. And last but not least, for security is revenue debt. And the easiest way to define revenue debt is to say everything that's not tax debt, right? So everything else. So one way that I like to think about it, there are two types of revenue debt. You've got your direct revenue debt, and then you've got conduit revenue debt. So direct revenue debt is self-supporting projects. That's how I think of it. The debt is paid back by fees and charges that are imposed on the users of the asset. So the most common form is the water and sewer system bonds. Customers pay for that service, the water and sewer, and those fees are used to pay back any loans needed to develop that project. Conduit revenue debt is basically just means there's an extra party involved. There's a conduit. There's a pass-through entity or an on behalf of entity that joins up in the transaction. The most common issuers of conduit revenue debt in Tennessee are industrial development boards, health education boards, public building authorities. These kinds of on behalf of boards or pass-through entities, they issue bonds to finance projects for private parties. So projects for charitable 501c3 organizations or low-income housing. These boards issue the debt, and then they loan the proceeds to a private entity who then pays it back. This financing method is typically used to permit the private party to realize the benefit of that tax-exempt financing. And one thing that's really important about conduit debt is that it's non-recourse to the local government. The bonds are secured by loan repayments by that private party. So it's not secured by the government's GO pledge unless they specifically put that in the contract. Most of the time, it is non-recourse to the government. And last but not least, the most common types of sale of local government debt, competitive sale and negotiated sale. Just to briefly go over these, with a competitive sale, parties that are interested in purchasing a local governmental entity's debt, they compete with each other to offer the lowest interest rate for the debt. The local government will typically publicly advertise the sale through a notice of sale and request bidders to submit bids by a specified time. The notice of sale will specify the parameters such as maturities, maximum principal amount, maximum interest rate. And once the bids are submitted, the bonds are awarded to the bidder that provides the lowest interest rate. In most cases, the bidders for the bonds are typically underwriters who resell the bonds to their customers. With a negotiated sale, on the other hand, a local government negotiates with a single purchaser in an effort to obtain the most favorable terms. General obligation debt and highly rated direct revenue debt is usually well suited for competitive bid, while other types of debt are better suited for negotiated sale. And just to note, our office does have to approve certain types of negotiated sale, so please always check with your counsel